Alrighty. All right, let's get started. So we're gonna start the podcast in 3, 2, 1. Shoot. Hey, welcome to Shout Digital Markester, the bi-weekly podcast where we discuss everything related to entrepreneurship and finding success in business online. And I'm your host Kazuki, and also the co-founder of So we're exciting from all the way from Canada in Toronto, Scott Howard, and he's also a co-founder of FactorChain AI, a company that actually uses AI and machine learning to automate risk assessment and deliver smart capital to SMBs supply chains by bridging DeFi lending into traditional businesses through capital as a service. And in today's episode, we're going to discuss the importance of revenue engineering and operations for business with all sizes. So Scott, welcome to our podcast. We're super excited to have you on this podcast. And I know that this topic is going to be a really interesting topic because it's also about AI. It's also about DeFi, which is, crypto involved. So everybody will be curious to know a little bit of what you do. So we'd love to hear your little bit of introductions.
Sure. Thanks for having me. Hope everyone can learn a little bit during the conversation, and always keen for more questions. So if you got questions offline, post conversation, happy to take them. And don't feel shy about interrupting me. And driving, especially, we kind of dig into the nerdier stuff. So the DeFi and crypto and all that kind of fun stuff there's no dumb questions there, as lots of investors have learned over the last 4 or 5 years, much less the last 12 months. Whether you're talking about traditional finance or decentralized finance, people should ask more questions. Is the best advice I can give anybody when it comes to their finances or technology. Ask more questions. But yeah, you asked me to introduce myself a little bit, so intro was pretty spot on. So Scott Howard, I'm based here in Toronto. I've been doing technology startups since 2009, pretty much exclusively from a founder, consultant, investor perspective. So I ran a fund from 2011 to 14, worked with about 45 different startup companies in that process, and kind of big part of that, the value add, and I kind of air quote that because the value add is the money. Every entrepreneur is looking for investors for one thing: money. If they can be non-intrusive and non-harmful after they give you the money, that's pretty much as value add as you're usually going to get. I like to think I was more, that plus a little bit helpful. And a lot of that was focused on how do you drive revenue? How do you get customers? And kind of my pre-startup life was big, large enterprise technology deals. So we would essentially do what's called IT outsourcing. So we go into a bank, into a manufacturing company, pharmaceutical company, say, you're not very good at running technology. We're a technology company. Let us run your servers, your applications, all the service platforms that go around that, and help you get more efficient by doing that. So essentially, like, carve out your IT department to give it to us, and we'll run it for you. And so that, kind of got me on the ins and outs of what does all this technology stuff do? How does it operate inside of business? How do businesses actually think about it? Certainly from like a Fortune 500 perspective in that environment. And what you realize pretty quickly is it's all just a financial transaction. How it actually does this stuff, the specifics of that are so far down the food chain in terms of decision making. They matter, and there's people that are really concerned about how you're going to do database administration at the end of the day, because it's the thing that they're handing over to you to do. But the board and the executives at a Fortune 500 company are like, are you going to deliver us back 20% of our operating budget, or are you not? And if you're not, you can leave. That's all we're interested in. And so it's a lot of financial arbitrage, frankly. And that translates into labor, and labor translates into how the technology gets used and how you lift your productivity. And it's pretty standard stuff in that environment, and I kind of translate that into working with technologists, entrepreneurs, startups of, if you're going to go to the enterprise, they don't care. No one cares how ChatGPT works. Not one lick. Can I fire 100,000 people that are working overseas that are doing chat support for me, for my bank or my telecommunications company. Can I get rid of all my call centers that, there could easily be 100,000 humans working in Iowa, working in Bangladesh, working anywhere else in the world that are doing that might cost you $1, might cost you $10 an hour. The only thing the CEO is interested in, can I get rid of them all for this ChatGPT thing? What will that cost? And they're just working through that process. Your large language, if you say the word LLM to me, this meeting's over. Tell me operating expense, arbitrage, transition time. What is the severance package is going to cost me? How fast do I get a payback on that investment? Will my board reward me for doing that or not? is all they care about. So kind of framing the technology in the what financial impact is going to create for stakeholders has always kind of been the focus, and that if you sell from that perspective, your opportunity to be successful is way higher. And way too many technology companies are just focused on, well, my features do these amazing things. Look how cool, like fundamentally you're saying, like, look how cool my toy is. And the other guy's like, I don't care. Does it make me more money? Tell me how it makes me more money. And so big focus in that area. And so kind of transitioned from that big enterprise environment, took that into startups, been doing startups for 12, 13 years now. In the last 4 or 5 years, it's been pretty heavily focused on Web3, crypto, blockchain technology, however you'd like to think of it. I like the Web3 moniker, so I kind of carry it that way. And what we've been doing for the last 2 years, 2.5 years almost now, is FactorChain AI. And so FactorChain is heavily focused on how do we use data to underwrite credit. That's the original data business is insurance. Insurance is underwriting. It's creating a statistical model of what is the probability of a bad thing happening and what will that bad thing cost. And in debt, not a whole lot dissimilar. Of like essentially, it's just a balance of the bad thing that could happen is I'm not going to get paid. If I loan you money, you're not going to pay me back. So I have to build a statistical model that measures the probability of you and then everybody else across portfolio. Am I gonna lose 3%, 5%, 7% of my money to non-performance or not? And how do I predict that and get into that? And all that's just statistics, large scale statistical models. So it's called underwriting. We're just looking at that. How do we use AI, more correctly machine learning, advanced statistics to get better insights to like what are the signals of risk, how do we measure those risks and weight those risks better. All a bank has ever tried to do is measure and weigh risk better than the next bank. They all dissolve to zero because they've done it at scale and blah blah blah. So like, let me tell you what a 35-year-old healthy male's life insurance policy would be for $1 million over 10 years. It'll be $100. Whether you're in California, Ontario, it's all the same, because that the statistical table of Western European, North American male, and you're gonna die at 78. Here's the numbers. Here's how we depreciate that math. If you and as more tech savvy humans, we look at that and go like, yeah, but if I'm looking at your Instagram and you're jumping motorcycles over and doing backflips, I don't like your chances as well as mine, who's like not getting on a motorcycle anytime.
That's not dangerous.
So you can start to create differentiated risk models when you start looking at more sets of data, more dynamic sets of data. How is in our case, we're trying to look at like how is the business actually running. A bank only underwrites based essentially on your balance sheet. How much money, how much cash do you have in the bank? Literally our bank, usually. What's the overall balance sheet value? Multiply that by 3, that's how much credit you can get. It's oversimple math, but that's pretty much how it works. And when they don't know what the answer is, they look at your cash flow and go, okay, how much unsecured line of credit can we give you based on if your cash, if you got a free cash flow of $1 million a year, we can probably give you a $100,000 line of credit and not worry about it. And all the discretionary stuff that you might do with a loan is typically line of credit, asset backed. It's tied to the machinery that it's funding, or it's tied to the business, which is fundamentally the balance sheet. And so how we kind of look at it is, we're interested in all those things. Like, I want to take it, hit a Plaid API and pull down your GL out of your bank account and go, okay, how much cash do they have in the bank? How much cash goes in and out of that account every month, to get a sense of the cash flow, just like any banker would. But we're going to do that with a data machine instead of humans. If you started a bank in 2022, I'd use AI to do all those calculations, not 17 people in a back office. So we're just taking advantage of that. But the real way we're trying to underwrite is looking forward. Who are the customers? What are the customer patterns? How are they buying from the person we're trying to lend to, the business we're trying to lend to? And can we create an accurate forecast that gives us an insight that says they're going to sell more next month than they did the month before, or more correctly, they're going to sell more in April 2023 than they sold in April 2022, and we'd like to finance that. And so it's really looking at forward forecast. What kind of data model can we create around that forward forecast? How much risk can we put onto that forward forecast? And really look at, is that data telling us if we loan you more money, will you make more margin? I'm not helping you get more revenue. I want you more margin. So if we give you another $50,000, that'll help you sell another $350,000 worth of product that generates an additional $160,000 of gross margin. That allows you, you're gonna pay me back. You're gonna pay me back by 50 grand. It's gonna cost you it's gonna cost you $1,000 or whatever it's gonna cost. Like, okay, $1,000, but I now have net 159,000 more dollars that can go into my operating budget. That's how you grow, and we kind of do that from a, I look at it as we're selling you growth capital that's going to allow you to continue to expand the margin of the business first and foremost. Whether that's now we can buy more efficiently to have our stuff, have our inputs cost us less money because we bought more, we bought it earlier, we bought it on better terms, or we put more money into product, got more product out to market, and captured that revenue faster, and therefore generate more margin. So really clear focus on providing capital as a service in order for the company to be our customer to be more productive. And that's fundamentally how we kind of look at it. This is going to help you be more productive.
Interesting. That's actually quite interesting that you mentioned it. And I know we kind of discussed it previously, and you kind of mentioned it as well, how you started your career as a revenue engineering. And I know for sure that right now, revenue operations, or another word, RevOps, is actually a pretty popular term right now around in SaaS world. So if you could tell us a little bit about your journey of becoming a revenue engineer and how you co-founded FactorChain AI in the first place.
Yeah, so big piece of my enterprise life, and then how I've kind of added value to all the startups I've been involved in, whether as a financier of them, operator of them, consultant to them, advisor to them, investor in them, has been kind of revenue operations. The most important product your company is to produce is its revenue engine. A product is an input to it. Almost all startups, particularly tech startups, get heavily focused. Like the product. Like the product's got one job for the company. It is to generate revenue. All the features, all the functionality, all the stuff that goes into it it has one job: get the customer to part with money because they see that product as valuable. They're like, oh, if I do that, I can now do the thing I was already doing 100% better, or whatever it is. And typically 100% is probably the right number to apply to that. It's like, can ChatGPT do customer support 100% better than my 100,000 people in India? Is the question that Viacom will ask. Because we get 20,000 phone calls a minute. People telling my bill's too high, my bill is wrong. Can ChatGPT solve that? 100% better than the way that they do it now. And if you match that, the product will be successful. But the machine that really makes the product go is all about how do I put that value proposition into the market from a marketing perspective so that our potential customers know that we exist, get some level of education and awareness so that when the business development rep or sales development rep sends the email, makes the phone call, does the DM, whatever point of contact they're going to go generate at a decision maker, they go, that thing might help me do a thing that's important to me 100% better than the way I do it right now. I'm going to engage with this piece of content, or I'm going to, better yet, engage with this human to figure out, is that true? And all marketing is trying to do is create, is the question in the mind of the persona you're chasing as a company, is that true? Can they actually do that? Will that work? And then will that work for me? And then can I navigate my processes from a company perspective of how can I engage with that product, get it in place, do all the stuff that needs to happen. And that's a big, in an enterprise environment for a big ticket item, a long, complex process. So it's kind of figuring out, kind of the revenue engineering of that is, do we have a system that 8 to 9 times out of 10 can match up with our customers' systems that go, I know who all the humans are, what their roles are, what their kind of core questions are going to be when they come in the room and go like, does this help our business? And so we as the seller are showing up going, we can help your business and here's how. Yeah, I know what your next question is going to be. Does it, what's this IT security footprint? How do we account for it? How do we integrate it? How do we change this? All that stuff that's going to happen with complex sales. We have a playbook and we have a machine that's oriented around that playbook that can engage with the customer, know that, oh yeah, no, you guys want to get the $722,000 a year contract out of us. We're going to we're going to have the CFO look at this deal, and they're going to have a bunch of people that are called controllers, and they're going to ask a bunch of stupid questions because they're accountants, not technologists. They're going to want to know these things. We as in our revenue machines got to go, we have to have a set of features in our revenue generating product that says, here's how we answer the accountant's questions. Here's the forms that they're going to want from us. Here's how we're going to have to tell them we're going to build them. All the stuff that they're going to be concerned about because they don't care that it helps the engineering team get 100% more productive. They care, well, they're trying to get a $722,000 deal out of us, and my job is to make that 20% less. And if we get that, then I also have to go put it in the right part of our general ledger, and I have to account for it, and I have to put it onto a billing code, and I have all the really boring stuff that salespeople aren't interested in. But if your product, from a sales motion perspective, is not aligned with that, you're going to waste a lot of time as an organization from a selling perspective. That's the number one thing that a startup doesn't have. They do not have time. So you got to build a machine that's going to make that every sales and marketing interaction that you're going to have as productive as possible. The way that we do that is with this thing called product management. And so we just look at how do we apply all the product management we took into building our widget, our software system, whatever we're selling, and have the same product management mindset kind of applied to how are we selling? What are the tools and systems, and then the humans that are going to go implement those things and do those things interact with the customer's tools, systems, and humans that are going to interact with this thing so we can get a match to make the machine work, so that if we think this is a 3-month sales cycle, more often than not, we got a 3-month sales cycle. We think it's 3 years, which, by the way, if you want to go sell $722,000 of stuff on a 5-year term to a bank, it'll take you 3 years. You better know how that works. You think banks, big bulge bracket banks are your customer. going to take them 1 year to figure who are you, which part of our bank cares that you exist, can we trust you, why, who, sorry I changed my job, bye. That's how those processes. And then year 2, they might even start to evaluate you. They go like, oh yeah, does that thing work the way we think it works, and will that pass our Sarbanes-Oxley processes, and and like you're gonna have to learn how to do all that stuff. And then year 3, you're actually like negotiating a deal, and more importantly, negotiating like, oh okay, so if we have to like give you access to our Oracle databases, how are we gonna do that? You're on Oracle. You know, and if you're a 27-year-old engineer from Silicon Valley, you don't even know what Oracle is. Is that sitting in AWS or sitting in Google Cloud? No, it's sitting in the basement here at the bank. And then you watch your engineering team's head explode. So it's building the 2 products of the business is the revenue engine. Nothing works unless you get revenue, because no VCs are going to fund you in 2023. Without that, so you got to figure that out. And then obviously your product's got to match up with that. There's a whole dance between your actual product and your revenue product, and they got to work together. But they both need to be highly tuned. And if they're not working together, you will fail on the product side of this to tune it to like, what does our customer need from us? What do I actually do for them? What value do I deliver? Who do I deliver to? And then how is the decision made? Even if they're a consumer. How does this tool make Scott happier? Oh, he just pushed the button and the record thing worked. Okay, cool. He didn't have to install 5 things and because you made him do 6 different things. You've been like, can I just call you? Keep using his old spin the dial on my rotary telephone. So it's trying to figure out, how do I get that change to happen inside the customer, because like there's very few new problems. ChatGPT is not solving a new problem. It's just solving the problem better, faster, and cheaper than we previously solved it. And I'll can use ChatGPT because everyone's playing with it. It's like, yeah, if ChatGPT can ask the question that I would have dialed 1-800 whatever on better, it's a good answer. It's good for me as the consumer. It's good for the consumer that is the telco company that I want to yell at about my bill, because now they don't have to have somebody to answer the phone. They can just have a widget on their website that says, here's the answer.
Interesting. I want to jump kind of straight into what FactorChain is all about, and what you guys are trying to solve. Especially you guys have interesting models to kind of leverage. So I know you might get this question a lot, but how does FactorChain AI balance maximizing yield with risk mitigations, and what challenges does this present?
Yeah, so the number one challenge is trying to get essentially a unique data set from the borrower, our customer. So we kind of look at, some of this is targeted on customer persona. So it kind of goes back to like, what kind of revenue engineer work are we doing? How are we framing? Okay, who has credit? Who has challenges around accessing credit? Mid-market companies. Let's just say $20 million. So your $20 million top line, you got $2.5 million of EBITDA. You're banked. If you're let's use kind of stick with North American examples. You're banked. You're banked by probably a reputable. You might have a Bank of America or Royal Bank of Canada. One of these guys is banking you, and they provided you credit. So you got a line of credit. You got probably a small business loan. You got a bunch of credit products. So you have access to capital, access to debt capital in particular, and so it's trying to figure out, okay, what job can we do for that market that's different than the existing traditional finance market isn't doing. And the way that we want to differentiate our ability to do that is like, well, they're all doing financial calculations. Tell me about your balance sheet. Show me your general ledger. Typically, send me your last 3 years of audited financials. And oh yeah, by the way, your personal audited financials as well. And tell me about the mortgage on your house. is how a lot of that goes for business operators in that space. And so we kind of look like, okay, well, that's painful. That's a lot of time. So what's the number one thing that kind of business operator is going to want? Whether they're executive team or owner operator, they're going to like, if I could spend less time, if I can get access to more capital without the 3 months that it took me to open up that account at the bank, and then the other 3 months that it took me to go through and get the small business loan processed and actually in the bank, like there's a lot of time. I didn't have to go pull out my shoebox of personal bank statements and all the stuff that I had to do to get audited. Saving them time was the number one thing that we're like, that's what's valuable to that customer. If I can just have a source of capital, it's a less painful process than a bank. And we've all experienced this as consumers. If you're a business operator, you experience it's painful. Just like the bank you're likely banking with is 100 years old. The processes that have gone into place to figuring out like how do we underwrite you and understand what you are as a business and what kind of risk you present to us is like based on the shoebox called your general ledger getting dropped at the bank teller and them going through it and underwriting it that way. And that's why their process from a bank's perspective is expensive, because a bunch of humans literally need to look at it, need to process a bunch of information, do a bunch of checks and balances that are all very human-centric. So 7 or 8 people are going to look at $1 million line of credit to a small business. It's ridiculous. Because like plenty of friends who've been commercial bank officers. It's just like, do you have $1 million of free cash and you're in the bank with us that are like on your balance sheet as free cash? Yeah, they'll loan you $3 million. But then they got to do a bunch of jiu-jitsu with the operator of the business to go like, I got to show that in an income statement. I got to show that in a balance statement. I got to like, you're more focused on building your product and servicing your customers than doing accounting if you're a $20 million company. But I, as the bank officer, I got to go talk to risk. I got to go talk to underwriting. Then I got to talk to treasury. And I got 4 or 5 departments that I got to go check this $1 million off with. So there's no way in heck I'm doing it for $100 grand. It's not enough juice. So these kind of next step that we looked at is like, how do they get access to kind of micro capital, micro lending, much more smaller doses of capital that allow them to do more flexible things, more specific things in their business that like, oh, if I had a better supply chain of capital, I'd be able to operate typically their supply chain or my go-to-market process more effectively. And all I have right now is free cash flow that's coming out of the sales of my product or my line of credit. And the line of credit's got a job to do. And usually if you're that that kind of or 5+ year old business and we got that kind of cash flow coming through our business, the performance of your line of credit's very clear. This is what we're going to use it for. This is how we're using it. Every 17th day of the month we use it like this because that's when payroll goes out. There's a pattern to it. So we want to get access to the data to see the financial pattern. What's the cash cycle through the business? And then more importantly, we want to see like what's the product cycle through the business? What are the inputs? What's the raw material? How do you process it and turn it into something? How do you get that something out to market? What are all the processes and expenses that go into that? And then how fast does revenue come back into the business and how much margin's attached to it? And once we kind of measure that, we start to look at what are the operational inputs that lead into that very long tail reporting thing that the bank looks at called your general ledger, which even in the most sophisticated businesses on earth is at least 90 days behind. And if I'm looking at the operating systems of business, if I'm looking at your manufacturing resource planning thing, your enterprise resource planning software stacks, however those go, and like they could be very, that could be QuickBooks in a lot of these businesses. Typically there's QuickBooks, and then there's something that, we work a lot with craft breweries. So there's some craft beer specific ERPs, enterprise resource planning software stacks, but they're literally like I'm a technologist and my brother's a brewer, so I took a spreadsheet, I turned it into a piece of SaaS, and some of those businesses are pretty interesting and good SaaS businesses, but they're kind of similar. They're $20 million, $3, $4, $5 million bucks of free cash flow SaaS, micro SaaS businesses that do that. They got great data. That data can tell me, as a lender, going like, how much does barley actually cost? When do they have to buy barley? How long does it take to turn that bag of barley into a case of beer, the case of beer into the case of beer on the shelf, and that case of beer sold, and that, okay, if it's sold to retail, how much margin, how fast do we get that margin back into the bank account? If it's sold to another retailer, what are the terms? How fast do we get that back? What are the margin? And kind of translate that all in to go, well, if I help him buy barley cheaper, sooner, more, whatever it is, if we give them another 50 grand, they could buy an extra pallet or whatever it happens to be. Can all of a sudden they produce more beer, generate more margin, or just that buying process, if I save you 10% because you're buying in bulk, is that good? And I go, yeah, okay, well I create a different term, your small business loan isn't going to do that. Your line, you could use your line of credits, where a typical competitor is the line of credit. Go, I got 80 grand. Like, well, why aren't you using it? Well, and then that's the sales process, trying to understand, like, okay, I know you're going to say line of credit. you got to build a whole mechanism. So part of our selling tool is like, once I look at the data, we have a data view of like, you don't buy that extra barley because you're worried, clearly, because this happens 3 out of 12 months. You use your line of credit to go do that, to go buy the cans, or you go upgrade your machinery or whatever, so you don't want to stress that out, and you don't do it, when you put that question to an owner operator, they go like, oh shit, yeah, you're right. Yeah, that's why we don't do that, because they're running their business. They're not thinking about it. They're obstacle to being Anheuser-Busch, Budweiser. Budweiser has 10,000 accountants. They have an entire building of people who are like, how much more efficiently can we buy barley? The only thing on earth that they do. Like the European barley guy, the American barley, and they got a whole line of just like, how do we buy barley better? Craft brewers like, this is the barley I like, because it makes the beer the way I want to make it. They're not thinking about like, how do I save 10% on my sales on my buying process from a system perspective. They think about it, but it's not. Anheuser-Busch has thousands of people who are literally have meetings about it every day. And that's what the economy of scale gets them. And so we're trying to how do we get your data as that mid-market operator and help you scale, get that economy of scale advantages of frankly using AI to go like, if I'm looking at the 10 brewers in the 10-kilometer radius from where I'm sitting right now, and go like, hey, you guys can buy more. Like, there's no news telling them like, hey, if you all bought from the same can guy and the same barley guy, and you did it in as a group in bulk, you get a better. They all know that. Their problem is, well, which one of us is the volunteer that calls the other 9 to gather up the order, and then call the barley guy, and then the barley guy is going to figure out that, I can sell more margin if I do it this way. We're going to see it through data. And so we're going to try and take that data attribute and push back insights and go like, here's how you guys scale as craft breweries without the coordination cost of trying to get your craft brewery association to turn it into a group buying association, all of which every craft brewery association on earth has tried that. Which I discovered through this customer discovery process of like, yep, they all experimented with, and they all essentially figure out like, what's the best group buying we can do. Our best group buying is, let's all just purchase a government relations officer to go to our, up to the state house or the provincial capital or the city and get better liquor licensing laws, because that's all that we can actually do collectively. And it makes sense for this business because they're regulated, yada yada. But coordinating, like, let's all buy cans together. You know, I'm sitting here in Ontario. The Craft Brewery Association of Ontario has got 359 members. No one's making 359 phone calls. Getting that information efficiently. So it's
amazing.
It's a big challenge of trying to figure out where's their pain, how do you tailor a product to that pain, and how do we kind of get unique around that? So the uniqueness is use data. And then the kind of secondary piece where we kind of really compete aggressively and we think we can win is because we're using stable coins. So essentially we're using digital currency. So we're using like USDC, which is US dollar coin as distributed by Circle. So it's a, you know, Ethereum token representing a dollar. So it's a, you know, these are dollar equivalents. These are cash equivalents. They're fully reserved, sitting in a fully regulated bank. You want to convert your USDC coin for $1. It's more likely you're going to get that deposit back from Circle than it would have been from a few banks that aren't currently existing here at the end of March that didn't have those deposits reserved. So we use that digital currency, stable coins, as ways to massively improve our capital efficiency. So we don't use intermediary banks to move the money. We send the money from our wallet to the customer's wallet. The customer then has an option to deposit that down to fiat at their bank. That's usually the slowest part of the process. Most, you know, they might get usually ACH it, so it's a day. But for us, as soon as we issue a loan, it's gone. It's out the door. So we put it immediately. So there's no T+3. There's no processing fees. There's none of that stuff that would go into, you know, I'm sure as a business operator, most of the business operators listen to the conversation. It's like, we've all been waiting around for that wire. And we've all gone what's my transit number and what's the Swift account? Oh man, I sent them the wrong thing, and they filled out the thing the wrong way. It's all that stuff is gone. Opening an account, moving the money back and forth, way more efficient from a time perspective, and then we're not, you know, there's no $40 wire fee or $1.50 transaction fees. All that stuff goes away because we're using the decentralized capital. We're not paying transaction fees from bank to bank to bank.
Amazing. I know you touched all the details on what you do and everything, and walk us through like any exciting developments that you guys are doing for a future plan for FactorChain AI.
Yeah, so the biggest breakthrough that we've had in the last little while is we've created a partnership here in Canada with a firm called StableCorp, and StableCorp is essentially the equivalent of Circle. So kind of folks that are familiar with the kind of global stage of decentralized finance and crypto will kind of, Circle should be a firm that kind of registers they're a large New York-based digital currency dealer. So they're the issuer of the biggest stablecoin in the world other than Tether, but unlike Tether, Circle's regulated. We can talk a lot of smack about how well or not regulation actually works, but you know, sitting in the Southern District in New York means that if you try to defraud people and not have the things that you state you have under those things, you go to jail. So Circle sitting in that environment. StableCorp is the same thing here in Canada, fully regulated, well audited, you know, Big Four accountants, all that kind of usual stuff. So we work with them around, you know, how do our customers, if I send them a stable coin, the Barley guy is not taking stable coin. The Barley guy wants Canadian dollars, wants American dollars to do that transaction. So with StableCorp, they've established the kind of fintech technology needed to kind of convert those stable coins into fiat dollars, one for one. No, again, zero expense. The only kind of delay might be on the other end of the customer's bank account getting that transfer. Usually the only window that around that be if it's over $10,000, it could get slowed down by a day. Anything other $10,000 is usually instantaneous. And so that whole push a button, immediate conversion to fiat, and then back and forth has really kind of opened up and made the transaction a lot cleaner. And that was a big piece of, that's more regulatory technology than technology. The technology's been ready for a year, but there's lots of rigmarole, as one would expect, with all the concerns around what are stable coins, and regulators and banks kind of looking at that as, there is some legitimate risk there, and then there's like 90% of it we don't understand it, and what we do understand is means like that'll probably be a better outcome for the customer, which means it's threatening to us. Therefore, we should go focus on the the scary parts below, and all the bad use cases that we can point to that, frankly, as inside the industry, you doing business with Terra Luna was pretty obviously a dumb idea if you actually read their documents. No, you shouldn't use Tether. They can't demonstrate that they actually have the deposits to back up the dollars. Business works, so people take that on faith, but it's that is not the use case for us in North America. It's just a basic understanding of trying to understand where these things sit from a business perspective, and it's a process of educating regulators and the financial industry around, well, we can follow all the rules, we can do all this stuff correctly, we can enable things to be better, faster, cheaper with this piece of technology, and ultimately customers want things better, faster, cheaper. And so we're going to go deliver that. So we got through the whole regulatory rigmarole with that in the last 3 months, really. And now that we're over the line on that, we can now kind of actually let the technology do its work. So we're moving into the kind of scaling phase of, we want to do lots more transactions with a lot more volume of transactions happening, because now we have the regulations out of the way, so now we can let the technology actually do the work.
Interesting. Well, before we wrap up this episode, I'd like to ask you one last question, which is, what advice would you give to aspiring entrepreneurs who's actually wanting to start their own businesses, especially like in the field of revenue engineering and operations? So can you give us like a little bit of recommendations on everything that we talked about in terms of what advice would you give to those people who's wanting to start their own businesses, or those people who's interested in the field of revenue engineering, and how that plays an important role for them to kind of scale the businesses?
Think real hard, and then seek to understand more correctly how you're going to generate revenue. How much revenue do you need to generate to create an interesting business? And how long do you think it's going to go from zero to the $1 million number, $100,000 number, whatever happens to be, to kind of go like, if you're a solo entrepreneur, if you're smart enough to build something interesting, like I'll use North America as my, like, how fast can I get this thing to generate $100,000 a year that goes into my genes so I don't have to work there anymore? Is the basic solo entrepreneur process of, like, if I can make $100,000 as a solo entrepreneur with no boss and blah, 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 that's a lot better than working at the bank or the telecommunications company or the agency or wherever I'd be working. And I might make $157,000 working there, but lots of tax advantages of being a solo entrepreneur. You'll put more in your genes making that trade. So let's use that simple example. Like, who can provide me $100,000 of free cash flow at the back of that? Does that mean I need to sell for $200,000 because I have $100,000? So what's the inputs that's going to go into it? But think about, how am I going to go generate revenue to make this thing a sustainable business? And if you have growth objectives, okay, I got to grow revenue to get to those things so I can hire more people, build more product, whatever it happens to be. So it's really thinking about the revenue equation, and that turns into, like, okay, what problem do I want to go solve? So that kind of ties right back. You can start with, like, I have a product idea for a problem. Like, okay, that's the problem I want to go solve. Here's the solution that I want to go solve it with. How much money is that worth? Do not pass go until you have a hypothesis about that. Way too many SaaS entrepreneurs, tech entrepreneurs just go like, well, that's a problem. Yeah, I can name you 20 problems right now. I can tell you who's got all those problems. I can guarantee you they're not going to give you $100 a month to solve it. They're not going to give you $1 a month to solve it. They're going to go, thanks for free. That's cool. You want to give it to me for, okay, how do you monetize free? There are ways to monetize free. Almost all of them exclusively go down the path of, I need venture capital to go do that, to scale that to a big enough number where the data economics in the back end or whatever that are going to work out. That's a whole different problem to go solve. If you can figure out, here's the problem, here's the solution. If I can deliver that solution, here's where I can find a price point that like, okay, that gets me to my $100,000. I got to go sell 100 people, 1,000 people, whatever, at a ticket price. And they're like, and I go talk to 10, 20 people that look like that, act like that, and say, hey, if I charged you $100 a month and I solved it this way, would you pay me? So like, it's obvious advice. Lots of people have given that advice. Very few people take it. Because I got to go build it, or I got to get a wire. You know. No, ask them. I have this idea. And if you don't know people who are going to answer that question, you're in a bad position from a selling perspective. Like cool that you're an engineer. Maybe you can sit back and go engineer it all out stuff and go test it. And there's that model, but like it's test the market, understand why it's valuable. How valuable is it in the terms of how much revenue will they provide you if you solved it? And then orientate to go like, how much product do I need to deliver to make that answer true? Can I get there fast enough inside the roadmap? You know, how much time has my partner given me to go do that? How much time does my bank account and my rent tell me I have to go do that? Do that math equation. Go like, be really disciplined around it. Be financially responsible with how you go about doing it. Be ruthless about trying to attack the number one feature of your product is the price. And the only entity that's really the number one feature too is the entrepreneur. Most of the customers don't. Like the customers really care about the price. You're not in a very sexy market. Your solution's probably not very sexy. Like if they're all the conversations about price, it's a really negative signal. Customers for something innovative or interesting don't care whether it's $900 or $1,000. Shouldn't even register. Like we did, point at the register was like, okay, I charge the customer number 1 $1,000. I'm gonna try and charge customer number 2 like 1,500. I'm gonna try and charge 2,000. I'm gonna charge. I've gotten nothing's changed. All right, let me see if I can get $5,000. No, $5,000's too much. Okay, I'll try that a few more times. Just take the first no, that's too much. Because if you can still get 2 out of 10 saying yes to 5. Don't have to be a math genius to figure out how the math, that equation still works out pretty good. So finding that upper boundary, that local maximum around what the price is that you can charge, and then fitting to that market segment and going like, okay, how big is that market segment? All the total addressable market stuff you can do. But that just kind of ties back to goal. Like, is it this? I want to put $100,000 of free cash flow into my bank as a solo entrepreneur, or do I need to go create a $100 million a year business that generates a couple $1 billion market valuation for my venture capitalists? It's just a TAM that's a TAM and price conversation. And so it's like really working, how do I orientate the machine, the revenue engine, around maximizing the price, minimizing the cost of acquisition of getting somebody to pay the price, and matching that so that process is, because the more efficient that process is, all these companies are getting shaken out here, kind of from second half of 2022. We're going to go all the way through 23. I have zero doubt of that. Going, if your unit economics aren't really good and your growth economics really, really good, the venture capital is getting totally turned off. Huge amount. If you're not delivering stuff that's better, faster, cheaper, doing more with less for your customer, you're going to get turned off. And so dialing that value equation and go like, the problem you have is severe. My solution is X. My solution makes the situation 100% better. I make that really clear to you really quickly. I validate that to you really quickly and really clearly. I implement that really, really effectively and clearly and efficiently. If I can do all those things, the customers are going to buy it. And if that's happening, investors with brains will try to invest in you. There's way fewer investors out there with brains than people like to think. But it's
Awesome.
Customers get really clear. It's like, oh, this solves a problem. I'm really happy with how you solved the problem. I'm really, the process that you go through to get them this. Like, I'm convinced you're going to solve my problem. I'm gonna do the effort, which might be nothing more than here's my credit card, or it might be a lot of like, I got to fire a bunch of people, and I'm going to have to rearrange how we do a bunch of processes, and we're going to have to do a bunch of stuff. All that spectrum is just like, if you make that easy and effective for the customer, they're going to buy. That's the revenue engine machine. Is all about like, how do I line that up to go, I understand what this is, I understand this solves my problem, I understand how I go from the start of this process to you fixed my problem, and get there real quick.
Amazing.
And it might be 3 years, it might be 3 days.
That's actually really valuable. Amazing. Well, thank you, Scott. That's really, really valuable. And that actually brings us to the end of this episode. Thank you, Scott, for joining us to discuss the importance of the revenue engineering and why is it so critical in any business ventures. We hope that you guys learned really valuable lessons from this episode. And as always, thanks for listening to Supercharged with Digital Markester. And if you enjoyed this show, please follow or rate and review us on Apple Podcasts or Spotify, and be sure to come back in the next 2 weeks for our next discussion. And until then, this is Kazuki, and don't forget, don't stop and keep believing, and see you next time. Great. Awesome. Thank you so much, Scott. That was really, really valuable and interesting topic.
Squadcast. I think I did something on another one that crashed a few times, so I think Squadcast might be the one to do. That was
this one we're giving it a try right now, so we're on a trial to see if this is the right fit